Hello and welcome back to another episode of the Investor Financing Podcast. And on today's show, we're going to kind of cut through the BS out there. There's a lot of chatter on YouTube. Everybody's worried right now. A lot of the real estate investors that were around in 2007, 8, and 9 that got their booty handed to them, they're kind of remembering it now because we had a huge run the last, 12, 13, 14 years. And now the music's stopping and people don't know what to do. You know, there's a lot of like cryptocurrencies that have crashed. A lot of those Bitcoin companies and so forth are filing BK. Stocks are down in a lot of sectors. Interest rates have doubled. Inventory is starting to increase. I'm in Las Vegas, and I was just looking at the stats, and residential homes are increasing, but we still only have 2.2 months of inventory in Las Vegas. So that's still a shortage by any means, but this is causing some fear. And if you go onto YouTube or you read any media publication now, it's starting to hit the media that, you know, it's becoming a normal market and there's opportunities for first-time home buyers. So today we have, I think, the best person that actually looks at data, right? Because if you're not looking at data, you're just making assumptions. And I think data is the most important part to look at. And whether it's good or bad, I think we're going to talk about some key indicators that will make us make more informed decisions on what to do. I think there's still opportunities, whether the market's appreciating or depreciating, whether interest rates are up or down. Business is business, and we just need to know what the actual data is saying right now and how we can best lay ourselves out there to, you know, make informed decisions and progress. Our guest today, Neal Bawa, is CEO and founder of Grocapitus. He has 2 commercial real estate investment companies. He has about $1 billion of assets under management, build to rent, multifamily. He's a tech-driven guy. His background's in tech and data engineering, and he's just a very, very highly sophisticated guy where we can learn from. I've been on many of his webinars, and we're going to give you some places to go after this recording so you can check out his slides and you can kind of get a deeper feel. But welcome to the show, Neal. It's good to have you back.
Thank you, Beau. It's good to be back on the show. And if you remember, my early part of my journey, what came from a event that you laid out. I think it was in the eastern part of of the San Francisco Bay Area that I presented at, and that was kind of one of the first big presentations that I did. And so I have lots of fond memories of that, and the connections and the friends that I made there, the relationships have survived to this day. So it's great to be back with you.
Yeah, it's amazing to watch your journey too. It's just I think it goes to show that if you stay the course, you're going to be successful, right? And you look at the data, you look at the emerging markets. You've done a very good job of that. You're in a lot of new trends, and also you're still doing your multifamily and growing that portfolio. What is the most concerning data that you're seeing today that kind of makes you think deeply that this could be ugly?
Um, Lenders. When I look at all of the different data out there, the one part that's scary today for people in real estate on the single family and multifamily side, it's the approach that lenders are taking to debt. Because nowhere in the United States is there current proof that prices have declined. There's 6 or 7 markets that I'm watching very closely where I think that there's going to be price declines happening in the single family market in the coming months. Multifamily, I think we've seen, on properties that are now going into contract, we've seen a 5 to 7% reduction because multifamily is very tied to interest rates. And so the impact there tends to be quicker and also more magnified than it is for single family. So we've seen that correction, but that's okay when you realize that multifamily prices typically in the last 30 years go up by 3 to 4% a year. And last year they went up 22%. So in a single year, if prices go up 22% and then they go down 7%, you're still having an incredible 18 months. You're having the best 18 months you've ever had in your career. So one has to take this into context, right? So, and those 18 months, you have to basically then combine that and then compare that to the US stock market, the S&P 500, the NASDAQ, and the crypto market as well, and the bond market. And I think that you'll find that real estate is massively ahead of those. So I look at it in context, but there's no doubt that today, when properties are going to contract in multifamily on a per door basis, their prices are definitely down 5, 7, in some markets 10% if they were very bubbly in Q4 and Q1 of last year. So I'm not seeing a lot of fear in those particular sectors. Really, what I'm seeing is the debt markets, because the debt market is pricing in the worst case scenario for the Federal Reserve, which is that the Fed will raise its internal rate, they call it the Fed funds rate, to 2.9%. It's at 1.5 now. They've got 4 hikes left to go, right? And which they've already kind of provided a nice uh, outline for. And so the debt market saying not only will the Fed raise all the way to 2.9%, which I agree with, but the rates are going to stay high for the following 2 years, which I completely disagree with. I think the Fed will do exactly what the mortgage market is suggesting and get up to 2.9% in the Fed funds rate, which means that real interest rates in the real world, we call them mortgage rates, would be 6, right? So 6 for single family, maybe 6.25, 6.5 for multifamily. The point where I'm seeing panic and lack of logic, lack of looking back at the past and basically measuring and looking at it is how long do those rates stay high? Is this the new norm and we stay at 6% a year from now, 2 years, 3 years, 4 years? That's what the market's pricing in. So I see a lot of panic there. And that's a problem because it prevents us from buying high quality assets that are available today, Bo.
And so, what about some operators that have bridge debt right now on their multifamily assets or their commercial properties, right? And they didn't see this coming, and now they're in a 2-year term. They've done their value add, and now they're rolling. They're underwriting at 4.25, 4.5. Now they're 6% money or 5.75. And so I think that could be a sticking point for some operators, the takeout debt, right? Because their loan's not going to size up based on DSCR, and so they're going to be maybe fall short on proceeds. So they might have to do some capital calls and so forth. I mean, that's probably going to come. Do you see that happening with some of these sponsors?
To some extent, but less than you think. So let me slice and dice what you just said into pieces because I really think you've got to slice and dice that statement. In itself, your statement is correct, but there's a few pieces to that. So let's say that Neal Bawa went out and bought a property 18 months ago and he's got bridge debt. Now, the last 18 months have seen the single greatest rent hike in US history. So the US is up 14.5%, high quality markets are up 20 to 30% in terms of rents. So if we bought this property with the assumption that bridge rates or our eventual rate was going to be 4.5 and let's say it's 6.5%, that delta of 2% should be more than taken care of if you were in a high quality market and you saw that 15 to 30% increase in rents that we've seen the last year. So I think to some extent this is to some extent this is fear mongering. Now let me give you a second scenario. Somebody purchased a property and I sold a bunch of properties in Q4 and Q1 this year. So I'm actually talking about the people that bought my properties, right? So they bought these properties in Q4 last year or in Q1 this year, and they basically closed on these properties in April. They're insolvent at this point because they didn't get the rent bumps. I did because when I was selling the property, the rents were going up, and so I was still getting the benefit of those in my sale price. And so when I went into contract in late Q4, we'd already seen some of that rent explosion. Maybe they got a little bit of it in Jan, Feb, March, April this year, but it was still slowing down. And so anybody that basically closed on bridge debt in Jan, Feb, March, and April of this year, those are the people that are in trouble, especially if they didn't get a big rate cap, right? So if they put the property into contract in January and chose not to get rate caps, I think that they are going to be in trouble. I think that they're going to have significant capital calls. The percentage of the multifamily market that fits this criteria of people that have basically closed on properties, let's say between December 1st of last year and end of May this year, that's 6 months. It is not a massive chunk of the syndication market, which in itself is a very small chunk of the overall multifamily market. So to assume that there's going to be properties coming back to the market at discounted prices is silly because we're looking at a very small chunk of a very small chunk. I do think that there's going to be significant distress to certain properties and capital calls. So I think it's really all about, did you close on something between December 1st last year and May this year? And if you did you have a rate cap? And even if you had a rate cap, did you have sufficient reserve? So I had two properties closing, but I refused to buy properties at the same price as I was selling them. So I was selling my properties. I sold one at 183,000 a door, and I sold one at 185,000 a door. The two properties that I purchased during this time frame, I purchased at 128 a door and 129 a door in markets that, let's just say, most people would not invest in. I am very, very aggressive because I use data science in investing in tertiary markets because I believe that today tertiary markets are the only remaining deal in multifamily. But I was basically paying two-thirds on the per door size, so I have less issues. But I can tell you, Bo, because I was afraid of this happening, I don't have a crystal ball, but I was afraid of it. Those two properties have the highest interest reserves that we have gathered in our history.
That's awesome. That makes sense. Now, when we're talking about tertiary markets, the data is saying basically like people can't afford these larger MSAs, so they're branching out and they're driving to work or they're working from home and they're okay commuting 30, 40 minutes into the major markets. And so that's what your data is showing, that people are willing to get a little bit nicer place or a bigger place and 30, 40 minutes away and then commute in. And so you think that's where the opportunity is because you're buying these properties at 120-ish a door versus 200, 185 a door, and they're paying comparable rents.
They're not quite paying comparable rents yet, but what's happening in those marketplaces. So let me be, blunt here. When I'm buying a property at 130, people are not paying the same rents as the properties I'm selling at 180. So there's a gap there. But my thesis is that that gap will be get filled because new construction costs have gone up so much, right? They've exploded over the last 3 years. They're up 40%. So these smaller markets have zero new construction plan. Like there isn't even anybody applying for a permit because there is no possible way for anyone to build a new building in these tertiary markets and break even because their construction costs up 40%, their rents are up 10, 15%. So there is a future explosion of rents that is going to happen to catch up to the point where new construction is possible. So I have 3 years of no competition in growing markets that people are fleeing to because the primary is getting too expensive. So for example, I'll give you an example of this. It makes it much easier for people to really understand this. Austin is the most red hot market in the world. We use 10 momentum characteristics in our data science projects. Of those, on 8, Austin ranks first. The other two, Phoenix ranks first, right? In terms of hottest markets in the US, in terms of momentum, in terms of what people think about these markets are going to do in the future, right? So I'm not, though I have some projects in Austin, the vast majority of my projects in Austin are not in Austin. I am surrounding the city of Austin almost like a siege. So east of Austin is the city of Manor. It's not even a city, it's really a town. I'm doing a major project there. North of Austin is the city of Killeen. It's actually that 50-mile radius. It's a 55-minute drive from there to the Domain, which is in a North Austin, very rich area, and has a lot of corporates. It has a lot of retail, and so people are basically driving from Killeen in. And then east and then west is Fredericksburg. So I'm looking at Fredericksburg. And then south again is San Marcos, where I have one major project, and New Braunfels, where I have two major projects. So when I'm looking at these cities, what I'm realizing is that the value is not in the city itself, it's outside. With Phoenix, which is the second hottest city in the US, I don't have any projects in Phoenix. In fact, you have to drive 35 miles from downtown Phoenix before you'll hit one of my projects in Avondale, or 40 minutes in the other direction to hit my projects in Mesa. So my first belief is that the suburbs, the next 10 years are for the suburbs, and also the next 10 years are for tertiary markets. So while I just described what you said, right, which is let's go further out into the suburbs, that's where the money is. In the future, Bo, a bigger portion of my portfolio is actually to true tertiaries. A true tertiary is not what I just described. right? It's not 50 miles from Austin or 40 miles from Austin. It's by itself. It is a self-supported city that doesn't have any anchor. So I'll give you an example. Idaho Falls, the nearest major city is Salt Lake City, 3 hours away. Boise, 4 hours away. I'm investing in Idaho Falls. I've done a project. It's a blockbuster success. I'm now doing a second. St. George, Utah, nearest city, Las Vegas, 2.5 hours away, and Salt Lake City, 3 hours away. I've done a blockbuster project and I'm looking for as many as I can get. Those are examples of the sort of cities I'm looking for. Port Charlotte, nearest city, Sarasota, over an hour away. Nearest big city, Tampa, 2 hours away. So this is my belief that the age of the tertiary has come because of two reasons. One, remote work, right? So you're seeing insane evidence that remote work is here to stay. If people think that folks are going back to the offices, you're just not reading the right stuff. There is no evidence that in any metro in the US, more than 60% of the people have returned that were white collar workers. No metro has 60. Some metros are still at 45% of key swipes compared to before, the pandemic. So I think the nature of work has changed for white collar workers, and so the tertiary markets are now more robust because they have something that they never had before: jobs.
That makes a lot of sense. I like that thesis. So my thesis is yeah, it sounds to me that multifamily will do fairly well during this recession or whatever we're going to call this. But everybody says, oh, well, prices aren't going to drop because the mortgage, these are actual people who are qualified to get these loans. I'm talking mostly the residential space, which is true. Back in 2005, 6, and 7, I was writing loans as a residential mortgage broker. And if you have a heartbeat and pulse and you have a credit score of over 660, okay, we can do 100% financing. It was very simple to get financing. Now you actually have to qualify for the financing. So I don't think we're going to have the same mortgage problems. I think we'll probably see some short sales because people have to move and they bought at the top of the market and there might be a 10%. When we talk about shortage of inventory, everybody says, "Hey, we have such a shortage of inventory." That's everybody's claim. We have shortage of inventory. How do we really look at this? Because I'm always confused on what the data really says. Do we really have that big of a shortage of inventory? Because it seems like what moves the residential space is people's thoughts, right? Like real estate was super hot. People were overpaying. All of a sudden they see some news. Now nobody's moving. And then the people that have 2.65 on their 30-year home loan, they're not going to move up to another house because I'm going from my $500,000 house to an $800,000, but I have a 3% rate versus now getting a 6% rate. So that's going to slow down. So I think the residential space, and I want to get your input on this, we're going to see a huge transaction slowdown because there's the move-up buyers. I think we'll see 30-ish% reduction in transactions this year, which is going to be a trickle-down effect to mortgage brokers, real estate agents, contractors. What's your viewpoint on, first talk about the shortage and then talk about, these people not moving because their rates and so forth?
Sure. So I'm going to get technical for a moment here. So let me make a statement. The shortage of housing is actually dependent upon the state of the economy. So imagine that the shortage of housing is not a number. So when people say we are 5 million homes short in the United States, they should actually be making a bigger statement. The right statement, the accurate statement is, if the economy is at 4% unemployment, we are 5 million short. If the economy is at 6% unemployment, we're only 2 million short. And you might say, oh, so just because of unemployment, the shortage reduced by 3 million homes? Yes, because the household formation in the US is flexible. It goes up, it goes down. In the early months of the pandemic, household formation collapsed because people moved in with the rest of their families. People kind of got together and lived together in the first 3, 4, 5, 6 months of the pandemic. So household formation collapsed, demand collapsed. But then people were like, okay, well, as long as this pandemic thing is not going to go away, so I'm going to just get on with my life. And people moved on. The government plugged in huge amounts of money, and so all of a sudden there were more households being formed, and the supply dropped because people were not listing their homes. Demand increased, and all of a sudden you had this massive one-time explosion in home prices. Now, today, The Fed's job at this point is to create unemployment. And I feel bad about saying that because obviously the Fed's not trying to deliberately do that. But the first direct impact of interest rates is layoffs. And you're seeing them in the real estate market. So we've said Redfin announced layoffs. We've had a bunch of other real estate companies announce layoffs, including some really big players like Chase, saying, "Hey, our mortgage divisions basically we have to shut down a portion of them because the demand's going to go down." So as demand goes down, layoffs happen. As layoffs happen, household formation becomes negative. And as household formation becomes negative, the total demand in the US shrinks. So your shortage that we talk about, it shrinks. So this is a living organism. It shrinks, it gets bigger. At some points when we're under 4% and interest rates are low, we need 5 million more homes. If interest rates are very high and the economy is in a recession, we actually don't need any more homes. So, and then when the economy comes back, it'll go back to some point to 2 million, 3 million, 4 million. So this is a shrinking, growing number. And that's why it's very critical that when demand drops off, often it can drop off a cliff, right? Now, what you might say is, okay, so we could be seeing a 2008 type scenario. Absolutely not. There is no data point that suggests that the real estate market today is equivalent to 2008 for a variety of reasons. Number one, Americans today have $27.8 trillion of home equity. This is by far the highest number that we've ever had. And home equity buffers people because if they have to make a decision to sell and they realize they can't sell at a good price, they can simply stop. That wasn't the case in 2007, 2008. We have a record low number of adjustable rate mortgages. Right now, ARMs are shooting up. In January, when I looked at the numbers, 3% of all single family mortgages were ARMs, which is basically zero, right? Today, in May, at the end of May, they were up to 9%, right? But I'm not worried about those because they don't adjust for 5 years. There is no adjustable 3-year product in the market at this point in time. Almost all the product is 5-year adjustable, and then it actually adjusts at the end of 5.5 years, not at 5 years. So bottom line is, if there is a bubble that is going to develop because of adjustable rate mortgages keeping interest rates down, it's going to burst 5 years from now or 5.5 years from now. It's going to start bursting at that point. So I don't worry about something that's not going to happen at this point in time. But that will support the market. Today, anyone, and we're recording this on July 12th, anyone can go to bankrate.com, plug in a 720 credit, 20% down, and you will immediately see adjustable rate mortgages under 5%. Under 5%. I challenge everyone to do it. It only takes 2 minutes. And people are like, yeah, but it's 5%. It was 3%, in November. Okay, let me give you a data point of how sticky housing is. How sticky housing is for Americans. In 1982, the Fed increased interest rates so much that the mortgage rates in the market were 18%. As we're recording this, they're 5.3%. They were 18%. So you would think, oh my God, 18% interest rates. Nobody in America would buy a home. Nobody in America would qualify for a home. So, home prices must have collapsed by 50 or 70%. Here's the real data. Home prices went down by 10% the following quarter, so which is the beginning of the second half of 1982, bounced back up 10% the following quarter because of the use of ARMs, and actually ended the 1982 recession higher than they started. Right? That's how sticky housing is. That's how sticky housing is, 18%. So what happened in 2007 was a failure of lending, was a failure to give loans to the right people. We gave loans to all the wrong people. But today, the average American that owns a rental property has not just $250,000 in equity in that property, they're also people with 740 credit, and they're not willing to give up on their credit easily. And the other thing is, rents were rising at 2.5% in 2008. Rents rose 14.8% in the US in the last 12 months. For single family, they rose even more, about 15.5%. So there's a lot of support for the single family market. There isn't support for transaction volume. I think transaction volume in the US is about to drop off a cliff. And the markets that are going to drop the most are Vegas and Phoenix. Those are the markets that were the most bubbly. So obviously, those markets have to calm down. So you're going to see transaction volume fall off a cliff at least 30%. But in certain markets, you might see 40%. Boise is another market that's been considered extremely bullish. And so I think that volume's going to fall there, and prices may also fall. So when I look, I'm following CoreLogic. CoreLogic is the company that produces the best data for single family. Because I'm in the multifamily realm, so people ask me often, why are you so obsessed with the single family market? And my answer is a healthy multifamily market requires a healthy single family market. You cannot have a a multifamily market that's growing if the single family market is shrinking. It doesn't happen because household demand is going to collapse, right? And single family then starts to compete with multifamily. So I'm looking at CoreLogic's data, Bo, and the first thing I notice is even CoreLogic, which is pretty bearish, they have been bearish for the last 4 or 5 months. There's only 5 or 6 markets where they're actually showing potential price declines out of 400, right? So Phoenix is in the list, Vegas is in the list, and those are Boise's in the list, and these are basically 5 to 15% price decline markets. But there isn't a single market in the entire southwestern of the United States, all of which are overvalued. We all know that every market in Texas, every market in Florida is overvalued. CoreLogic is saying 100% of growth markets in the US are overvalued. But when they talk about price declines, there isn't a single market in the entire Southwest that is supposed to see a price decline. So people have to understand if if folks buy homes at 18% interest rates, they'll certainly buy them at 5.5, especially because of the use of adjustable rate mortgages.
So okay, so I live in Las Vegas now. My neighbor just put her house on the market, sold it in a week, right? It was priced right. I watched it. I was like, okay. I am looking to to buy another house, to move into, right? But I know, when do you think the lag is going to hit? Will it be, is a single family like a 6 month lag? Like, would you say November, December, we should start seeing kind of a little bit more? I don't know if you want to even say blood in the streets, but when would be like an optimum time, do you think, in single family?
It's too early. It's far, far too early. Remember, my answer is very simple. I could give you 6 different answers, but I'm going to give you the one that's easiest, right? Unemployment has to go over 5% for a single drop of blood to be on a single street. The US unemployment rate is incredibly low. And as you know, salary increases in the last 12 months have been incredible because of inflation, right? So if you're increasing American salaries by 4.6% and unemployment is at 4%, where is the blood going to come from? Where's the person that says, oh my God, I am going to sell this home for 20% less than its value? You can't find such a person. First, you have to have mass hysteria about unemployment, and that happens when unemployment goes from 4% to 5.5. Remember, you can't even really go into a US recession until unemployment's closer to 6 or 7%. Right? I mean, that's typically when you tend to see US recession. That's what the Fed's trying to do. They're trying to create these mass layoffs to slow the economy down to zero. And to do that, they basically are going to raise the unemployment rate. So keep an eye on the unemployment rate. All talk of blood is nonsense until there's significant acceleration in unemployment.
But you do think there will be a greater unemployment rate within the next 6 months? Is that if you
It's
took, yeah.
it's inevitable. So interest rates have a 100% statistical correlation with unemployment increase. 100%. Right? And you're already seeing it. I mean, just type the word layoffs into Google and you'll notice 5 articles from today, 5 different companies, big ones, right? Layoffs are inevitable in a high interest rate environment. Absolutely 100% correlated. Lots of other things are not correlated, right? I can tell you like that things happen that are like somewhat correlated with other things. But unemployment is very highly correlated with interest rate hikes. It's just it takes several months for companies to start laying people off because they take a few months to figure out what they're going to do before they start announcing layoffs. So my prediction is September, you will just hear no other word except layoff. Right now, the word that you're hearing is inflation, inflation, inflation. It's the only word that exists, right? Well, in September, the word's going to be changing to layoffs, layoffs, layoffs.
Around September, you will see it. I just was reading one of these non-QM residential lenders. They do the non-QM. They just closed their doors like abruptly. Sprout Mortgage was just all in the news. So I think we'll see more of that because there's all these non-bank, non-QM DSCR lenders, and they were selling these loans off in the secondary market. I think the buyers, these big REITs or hedge funds that are buying this paper are going to tighten up. What's your thought? And I know this, I know you have an understanding of this, and you probably own some short-term rental properties. It seems like there was a huge run, right? The last 24 months, people were going to the Smoky Mountains, people were doing this and that. How do you think short-term rentals are going to hold up in these just like really like touristy destinations? If in fact unemployment goes up to 5 or 6%, the middle class will stop taking as many vacations. Do you think that market will get hit a little bit?
I think a little bit. I don't expect to see enormous amounts of blood there either for a number of reasons. So we are now seeing record amounts of travel across the US, right? And even as unemployment goes up, remember household balance sheets. You always have to look at what's different from 2008, okay? In the last 24 months, $5.8 trillion, dollars, that's $5,800 billion, dollars, went into bank accounts of Americans. And what was interesting is compared to 2008, where most of the money went to the banks, right? So the money that we printed, we gave it to the banks, we gave it to the auto industry, we gave it to, those kinds of places. This time we distributed money to Americans, right? We airdropped money on them. So out of that $5.8 trillion, dollars, nearly 3 trillion, half, went to families making 50,000 a year or under. So household balance sheets are in the best position since 1950s. So it will take time. It will take time for even unemployment to make a dent in that, which is why I think that the Airbnb market is going to suffer, but it is not going to collapse. I think that because there's also a very strong desire for revenge travel. You might say, well, Beau's been traveling for a year, Neal's been traveling for a year. The answer is no, we're not representative. We're not representative. We're still early movers. We've only started to see travel get back to where it was in the last few weeks. And it's going to take a year or 2 years for everyone to get their revenge travel, this revenge against COVID, out of their system. So I think that there's significant travel, especially domestic travel, ahead of us. Maybe not international, but domestic travel ahead of us. So I think the Airbnb market might surprise people in terms of how resilient it's going to be because there's something supporting it, something big that's supporting it.
That's great. What about where do you see the emerging markets? I know we're talking tertiary markets.
Mhm.
What other asset classes do you really like? I know you're, obviously pro multifamily. What else are you investing in?
I'm investing in self-storage. I haven't really managed to find a property, but we've been looking. And the reason for that is, the biggest phenomenon that really is affecting our life, our work, your work, my work, is remote work. It is so massive. It is so widespread that it's affecting every single market in the US. And what I'm tracking is how often are people moving through the economy, right? How often are people moving? I mean, sure, they could be moving from California to California, but how often are they moving? And the data suggests to me that basically America is now going to move more often because they have so much ability to move because of remote work. It's almost like freedom to move. And so as a result of that, I think that we are going to see some of these tertiary markets continue to do well, and we are going to see self-storage do well because anytime the amount of moves goes up, the self-storage market tends to do well because people stash their stuff. And so there's a significant long-term benefit there that we're going to see. The industrial market is going to continue to do well because e-commerce bounced up. So we went from 9 to 10% of all U.S. retail all the way up to 25%, and then now we're retrenching back down to about 20. But we're still on this long-term upward trend. We still need more industrial warehousing space. So I've invested in both self-storage and industrial. Frankly, not enough. I should have done more. But those two markets, I think, will continue to do well. The markets that I'm very, very bearish on are office because I am tracking every month how many key swipes are being made in major metros like the San Francisco Bay Area, New York, Seattle, the big markets where office is expensive. The key swipes are not coming back, Bo. We're still below 60% in every single market. Some markets are at 45%. So I mean, at this point, COVID's gone. It's not a pandemic, it's endemic, which means it's with us forever. And so we're just moving on with our lives. And if at that point we have 60% key swipes compared to Feb 2020, the nature of Office has changed. So I think Office is in the biggest meltdown in its 100-year history. So that's the market that is going to get damaged. Now, being in multifamily, that's good for us. Office is a big market, and so a lot of office investors are now moving over to multifamily. So the office family offices that never invested in multifamily because I mean think about it they look at multifamily badly. So here's what I heard 4 or 5 years ago. I go to a conference and there's a bunch of family offices that only invest in US, Class A office. And here's one of those people. He was sitting across from me and he says, "Why would I invest in an asset class where I have to deal with people that only have 400 bucks in their pocket? So even if their car breaks down, they can't afford to pay rent. And you have all these ramshackle buildings that don't look very nice. And every time there's a recession, you have delinquency. When I'm dealing with Google, I'm dealing with Microsoft, I'm dealing with people that have $100 million in the bank and they sign a 5 to 10 year lease." Everything he said makes sense. That's why people have been investing in office for a long time. But everything he said then has no meaning today.
That's strong. Yeah, yeah, yeah. It's interesting how the shift is happening. So there's people. So the world's changed. People are going to work from home, remote work. People now that means they're going to be able to work to live in tertiary markets. So what is your favorite West Coast state that you think has the most opportunity? Would it be a place like Utah, or any favorites on the West Coast?
Let me think about that. Yeah, I think I would pick Idaho ahead of Utah. So Boise, even though it's inflated at this point, so may not be the right place to buy today, I think is that market that's special. And so over a 10-year perspective, I think Boise will do really well. And Idaho Falls, which is the secondary. Remember, I always invest in a market near the red hot market, but not in it. So I haven't invested in Boise at all, but I think that I'm a beneficiary of Boise. I think that market will do well. Utah has a bunch of really, really good markets. So Provo is incredible. Ogden's very strong. And then smaller markets like Logan are good. So is St. George. So I think that Utah, Idaho are strong beneficiaries of this true tertiary market trend. Remember, there are other places that I could mention. Tucson's very strong. I think that it's a beneficiary of the supernova that's Phoenix. So I think that on the western side of the US, those are some of the picks that I would make. Tacoma is a dangerous market today, but Spokane is a true tertiary market because Seattle's 3 hours away. So you should look at Spokane. I think those markets I think might really do well. California, not a lot except for Riverside. I continue to believe that Riverside is a very strong market and it has more value than it's been, given. I think Los Angeles is going to have severe problems, very severe problems. San Francisco Bay Area, not so much. I think this is a superstar market, so it'll continue to do well. It's just not going to go up at the same rate as the rest of the U.S. So you might just see a decade-long plateau in the San Francisco market with some dips and some ups and those sorts of things. Um, not a lot on the western side that is easy to recommend. It's very difficult to find growth markets on the western side. Vegas, once again, today Vegas is a problematic market, but I think that things will adjust over the next 12 months. It's still a market that's seeing a massive amount of inbound migration, especially from Los Angeles, but also from other markets in California. So I'm generally bullish on Vegas, maybe not in this window of time.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. Let's now talk about PropTech technology as we're wrapping up our conversation. What do you find interesting, and what changes do you see like in anything with technology? What do you think we're going to see over the next 5 or 10 years?
I think the big one, and I've done a lot of research on this. I actually have a PropTech webinar that I'm teaching tomorrow or on Thursday evening. So I've kind of presented my research there. There's a lot of things happening in prop tech, everything from 3D printing of homes to modular homes that are built offsite, to fractionalization, tokenization. Basically where you trade tokens on the blockchain. The extraordinary meltdown that we are seeing in the crypto market means that the tokenization initiatives are dead at this point. No one wants to touch them. There's this, stigma attached with the tokenization market. So I think that anything that was going to happen there is now pushed back about 2 or 3 years. I think those are all great initiatives. They're very valid, but nobody in their right mind is going to put money in there at this point in time. So even the tokenization startups that had mushroomed are either going to shut down or going to go back into hiding. So when I look at what is possible today, it's the cousin of tokenization. It's called fractionalization that I think is going to really come in, right? So Robinhood made it easier to use apps like E-Trade, right? And I know right now is not a good time to talk about Robinhood because of the stock market crash, but the truth is they did democratize stock investing for millennials. And I think that anything that democratizes real estate investing for millennials is going to gain traction. Fractionalization is very different from tokenization. What it does is it takes a building, let's say a $50 million multifamily, and they do an IPO, an initial public offering. So it's basically stock, real stock. And then they sell not tokens, but shares at, $50 or $100 for that particular building. Today, doing an IPO on one individual multifamily building is hard. But the way that the world is moving forward, all these bigger players, like Joe Fairless, could basically take 20 of his buildings that are $30 million each, wrap them into a $600 million portfolio, and then he could basically take that IPO, fractionalize it, and sell those tokens, and basically get worldwide reach. So I think that fractionalization, which is different from tokenization, is going to really gain traction. It's good for us because anytime you see a new kind of financial product come in, the value of the product goes up, right? So, there's more buyers that come into the marketplace that can buy $1,000 multifamily chunks. They don't have to be accredited, by the way. The moment you go through an IPO, the whole accredited investor requirement disappears, right? Because anyone can buy stock. You don't have to be accredited to buy stock. And so what is happening with the Securities and Exchange Commission right now is they're launching new rules to make the process of doing IPOs simpler and faster. Right now, it takes quite a bit of time, but in the future, it's going to become very, very simple and very fast to do these kinds of limited IPOs. So I think that is the biggest indicator. I was bullish on on um, um, modular construction, offsite construction. I'm absolutely not. I have to say this has been an area of great disappointment. All of my research indicates that modular is simply not ready in the US. I think it's great for Europe. It's not ready in the US. There's no supply. And we can't even build at this point 5,000 units a year using all of the modular capacity in the US. And we really need to build, 1 million units between single family and multifamily. So it's not a solution. It's not scaled. It doesn't mean anything in the next 5 years. And neither does 3D printing. I think 3D printing is a huge threat to real estate, but not in the next 5 years.
Yeah, that's interesting. Always been kind of bullish. I've never done any projects on modular. It just always made sense. Oh, I can build it in the factory, and we could. I've seen some investors do well with it and swear by it, right? But I think those are one-offs versus
One-offs. I mean, certain examples. If you look at 100 construction projects, I will bet $1,000 that one or two make sense to do with modular because of their location. Remember, the biggest cost in modular is not the panel, it's the shipping. So today, cost of shipping is up 5x from where it was 3 years ago. And so if you're building a project that's 20 miles from a modular existing factory, you might be that project where it makes sense for you, right? But if you're 2,000 miles away from a factory, I guarantee you're going to end up paying way too much.
Yeah, it's interesting. I look at companies like Boxable, right? They're doing a big capital raise now, and they have a huge list of buyers that want to buy these because you can basically ship these ADU units to your backyard. I think I think in California, the ADU market makes sense, right? Because it's like,
It makes perfect sense.
yeah,
I
yeah.
think that market is going to continue to grow. Modular makes all the sense in the world for ADUs. It doesn't make sense for multifamily at all. And I hope that changes because I feel like this is where technology has not been supported by the government. I think if there was $1 billion in grants that the US government should place for housing, they should spend all of it on modular factories, every single cent. That's the best use of their money to scale modular because it doesn't really start to scale until you're, putting out 10,000 or 100,000 units. Just like Tesla couldn't make the three work until they were, basically, building 250,000 cars, and that's how their price came down. We're not close to that yet, so I don't think that there is a modular revolution coming in the next 5 years.
So as far as the stock market, do you think like Bitcoin's around 20,000? You think Bitcoin will continue to decline probably for the next 2 years, and then maybe it'll rebirth itself. I don't really follow that much in the cryptocurrency, but I'm just curious, like what your thoughts are on on Bitcoin, for example.
Sure. I think keep in mind that when you look at the stock market is a very early indicator of recessions, of declines. So the US stock market, its bottom in 2000 was in March 2009, even though the real estate market bottomed in 2012. So the stock market tends to bottom very early. Also, in during the COVID crisis, the stock market bottom was actually in the first month of the crisis. So the stock market is very adaptive. It very quickly understands the challenges and adapts to it. So I think we're close to the stock market bottom. There's still, bad news coming from the layoffs. So you might see a further decline of maybe 5 or 6%. Bitcoin is completely untethered. It does not work well in a market that's going down. So the chances of it staying at 20,000 are almost zero at this point because the market is going to decline. So when the market declines, Bitcoin, which is basically based on people's feeling that the price will go up, I mean, how many people are going to feel the price go up when layoffs becomes the most important word in America? So I think Bitcoin might hit 10,000. And if you ask me what I'm going to do, I'm going to buy. As far as I'm concerned, Bitcoin's a great buy at 20,000 or 10,000 because I think that the fundamental problems that led to the creation of Bitcoin, we're accelerating them with these recessions. We're accelerating them with money printing. So at some point in the future, which I couldn't even begin to guess, could be 3, 5, or 10 years down the line, I do think Bitcoin will hit 500,000. But I have no idea when that is because I can't possibly predict the future rate of money printing. I just feel that the premise of Bitcoin is real. So if the price drops to 10,000, I'll be buying.
Awesome. Now, I think everything you talked about, I grasp the concepts of everything you said. And I think you break it down in a way that the average Joe that doesn't study economics like you do can kind of understand what we're going through. So to recap, in certain markets like Las Vegas, Phoenix, Arizona, there's probably going to be a 5 to 15% price decline.
That's
Most other markets, there's probably 3 to 5%, if none, because
I think none at this point.
none
We're
at
still
this point.
predicting a 4% increase in home prices over the next 12 months for the entire US. And strong markets could be 5 or 6%. But obviously that doesn't compare well with, 20% in the last 12 months.
And then rent growth will be where would be kind of a national kind of are we going to be flat, or are we going to still see rent growth, or that's going to depend on when this unemployment wave hits?
It really is dependent on unemployment. Rent growth ties well to unemployment. So I think rent growth is going to be strong in the next 3 to 4 months. So you might see rent growth at 6 or 7% annualized for the next 4 months. Because remember, rent is a trailing indicator of home price increases. So we'd have had in the last 12 months a massive increase in home price, which means that rent growth should now continue to be strong for the next 3 or 4 months. It's going to trail off close to the end of the year as the layoffs, strengthen and as unemployment, increases. And then I expect it to be really flat for next year. I think we need to take a pause. 6 years of rent growth in 1 year means that at some point there has to be a pause. I do not believe that you're going to see rent declines in strong markets in the US. Overall, the US might be flat, which means some are going to see declines. But all of the strong markets in the US that we tend to invest in, it's very difficult for rent growth to be at a decline. And I'll tell you why. If people are unable to buy homes, they have to live somewhere. So whenever as long as we don't see a 2008 recession where household formation is negative, as long as household formation is flat, right? Interest rate increases mean people can't buy homes. Well, then the same number of households still have to live somewhere. They tend to rent. So there's actually a benefit, and you tend to see occupancy tick up when unemployment's increasing slowly. If it increases sharply, then rent growth becomes negative. And so I'm betting rent growth is going to be flat starting November, at least for the next 7, 8, 9 months after that.
Very good. Neal, where can people get that last webinar you did on
Sure.
what the recession's doing to the economy and all the data points that you pulled up on all those slides? That was really good. Where's the best place for
That
them to
is it's available at multifamilyu.com. So that's the word multifamily followed by the letter u.com. We store it there. If you can't find it, just click on a help link and somebody will hand it to you. It is a terrific webinar. We did this in podcast mode, but I think that it's really, really worth watching it. There's a lot of interesting data points that I wasn't able to bring up in this podcast. So it's called The Impact of Interest Rates on Real Estate. So check that out. It actually talks about the impact of of interest rates on everything, with real estate being kind of the big focus.
And then your PropTech webinar, is that going to be on Thursday? Is that something that the
It's
public
this Thursday.
Yeah.
Yes. Once again, same location. Just wait until next week. You should see it stored at multifamilyu.com.
Awesome. Well, everybody, I hope you enjoyed this episode. I think we gave you a very clear picture of kind of what the data points to. Now, every market's different. We all know that, and nobody's got a crystal ball. But I think we can look at data and we can really say, well, look, there's more equity than ever in houses. There's higher credit scores. People don't want to lose their credit. People don't want to lose their home. So will certain markets that have appreciated like 120% in the last 3 years, like Las Vegas, right? It's just blown up. I don't know what the actual number is, but last year it was like 26% appreciation. If you give back 10 or 15% of the 50% appreciation you made over the last 2 years, it's not the end of the world. And I think migration is still going to happen here. People are moving here from Southern California, from Northern California. I don't think the migration out of California is as significant as many people thought. I think California will always remain a pretty strong state because it's got a lot of benefits. So I think you will see people moving out. You will see tertiary markets growing. You'll see a lot of people that like living in tertiary markets because they don't want to live in a city, and now they can work from home. The proof's in the pudding, guys. Just start studying. Follow Neal because he puts out a lot of free content, and he talks data, and he's not just pulling smoke out of the air. We're just looking at data and we try to interpret it, and that's the best way to go. So thanks so much, Neal, for your time, and thanks everybody for watching.
Thank you all. Have a good one.